Welcome today. Our focus will be on climate accounting. The content will be an introduction. I will go and look at what really is climate accounting. It's sort of a mantra today. So delve deep into what climate accounting really is. Then why does climate accounting matter in this present time and age? After then, we look at the key components or constituents of climate accounting. Then we'll look at greenhouse gas emissions. What are the components of the greenhouse gases based on the Kyoto protocols or other Montreal protocols or other protocols that actually includes the greenhouse gases? Then we'll talk about a little bit of the difference between climate and carbon accounting. Why does climate accounting matter to accountants and must be included in the financial reports? Then we look at the key frameworks that guide climate accounting reports or disclosures and challenges in climate accounting. After then, we'll look at the opportunities, which the ideas of climate accounting or climate risk pose. Because we look at risk, it's actually a two-way thing. We actually have the upside to risk and the downside. So look at the opportunities which the climate accounting or climate risk possess. Then we'll end with a conclusion. Measuring what matters in a changing climate is quite key. We need to actually look at the key factors or the key performance indicators in measuring what matters in terms of the changing or dynamic climate. The introduction: if a company reports profits but ignores its environmental impact, is it truly performing well? Climate accounting answers this question. If you look at what we call the tragedy of the horizons, we're actually having an effect on the climate right now, but the future generation will actually have more impact. So we need to look at the impact our businesses, operations, and ventures have on the climate at the present in order to actually safeguard the future generation. What is climate accounting? Climate accounting is the process of measuring, reporting, and managing an organization's climate related impacts, risks, and opportunities. This includes greenhouse gas emissions, climate risk, which includes our physical and transition risk, and the financial implication. Going by the definition, we need to measure our climate impact to the environment. And in measuring our climate impact, we need to look at the greenhouse gas emissions. When we are looking at the greenhouse gas emissions, we are looking at the carbon dioxide emissions, we are looking at the methane emissions, we are looking at the nitrogen oxide emissions, we are looking at the fluorinated gas emissions. And we need to report this impact on the environment and also the impact this has on the business. And we need to manage this risk in order to thrive in a changing and dynamic environment. Why climate accounting matters. Environmental importance. Climate change impacts business operations. Because of the time and age in which we actually operate, climate change actually has a major impact on our business ventures. It could be risk due to flood, it could be risk due to change in precipitation level, it could be transition risk from change in demand, it could be transition risk from legal implications or legal suits. So the financial importance is also the impact climate risk has on our asset values. It could be an impairment on assets. It could be a large cost from flood or hurricane. And it could affect our revenues as there's a shift or transition to renewable sources of energy. Businesses that are actually sort of carbon intensive might actually suffer a shortage or reduction in revenue. Also, stakeholder pressures. Investors demand transparency. Regulators require disclosures. Investors, institutional investors demand transparency, and that is the way to go. You actually have principles for responsible investing. We actually have principles for responsible banking. So institutional investors are quite keen on transparency, on climate risk and opportunities. Also, a lot of regulatory pressure requires disclosures for our climate risk and opportunities. So the changing environment, both for investors and regulators, will actually have an impact on how we report the climate risk and opportunities. What are the key components of climate accounting? CO2 and other greenhouse gases. What are the other greenhouse gases? We actually have nitrogen oxide, we actually have sulfur hexafluoride, we actually have methane, and we actually have perfluorocarbons and hydrofluorocarbons. These are actually sort of the greenhouse gases that actually have a major impact on the business operations and ventures. Physical risk. Physical risk involves both the acute and chronic risk. And the acute risk are sort of short-term, more pervasive risks, sort of such as hurricanes, floods, whereby chronic risk are sort of takes time, and it involves things like change in precipitation level, change in temperatures, which might have a major impact on our business venture. Transition risk involves things like policy and legal risk, change in demand, which is sort of the market conditions, and also technological risk because there's a shift from carbon intensive industries to renewable industries. And things like electric vehicles might be a sort of the way to go in terms of transitioning to a less carbon intensive economy. It could actually impact on our assets. Things like impairment of assets, our oil reserves might be stranded. It could also actually affect our provisions and liabilities, whereby there are lawsuits pending in terms of transition risk. What are the greenhouse gas emissions? There are actually something called the Scope 1, Scope 2, and Scope 3 emissions. The Scope 1 emissions are direct emissions which are from company vehicles and the company's processes, whereby the indirect emissions could be added on processes like electricity. And we actually have the Scope 3 emissions, which involves our value chain emissions, such as our suppliers and customers, which is sort of the bulk of our greenhouse gas emissions. Climate versus carbon accounting. When we hear things like climate and carbon accounting, these are sort of mantras today. They are actually sort of interrelated. While climate accounting is a broad concept, carbon accounting is sort of a narrow focus. So carbon accounting is a subset of the climate accounting. Climate accounting involves risk and financials, whereby carbon accounting focuses on emissions, which is the Scope 1, the Scope 2, and Scope 3 emissions. Climate accounting is more of a strategic vision, which is sort of a long-term process, whereby carbon accounting is more of a short-term and operational process, whereby we need to control our greenhouse gas emissions. Climate accounting and financial reporting. Impact on accounting standards. Climate accounting and financial reporting are sort of one and the same because we look at the job of the accountant. One of his aim is actually to report issues. So in climate risk and opportunities, we need to report these climate risk and opportunities. How does climate accounting affect our accounting standards? It actually affects asset impairment, which is covered by the International Accounting Standard 36, which deals with impairment of assets. It also affects our provisions, our contingent assets and contingent liabilities, which is the deals with the International Accounting Standards 37. And it also affects our businesses as going concern because climate accounting or climate risk and opportunities is sort of material, which means the omission or misstatement of this risk will have an impact on users of the financial statement. So we need to actually report our climate risk and opportunities. So this can actually have an impact on the financial statements, which involves our statement of financial performance and statement of financial position. And a note to the accounts needs to be made on how we actually measure this climate risk. But the greenhouse gas protocol sort of actually is a framework or is a standard that actually measures or gives us a platform for which to actually measure our greenhouse gas emissions. So what are the key frameworks that actually guides our climate disclosures? We actually have the International Sustainability Standards Board, which actually has the International Financial Reporting Standard S2, which specifically deals with climate risk. It focuses on financial materiality. What do we mean by financial materiality? It means how sustainability affects the company. So it means how climate change affects the company. So it looks at the outside in approach. How does climate change affect our business and ventures? Whereby the Global Reporting Initiative focuses on impact materiality. It deals with how the company affects the world. So it's a reverse approach, which deals with the inside out. So it deals with how the company affects the world. How does our emission affect the world? So the impact of our emissions on a lot of factors, whether it's health, whether it's other business ventures, and a couple of other ideas. European Sustainability Reporting Standard, which was developed for the European framework, focuses on double materiality. So it actually is a consortium of both the IFRS S2 and the Global Reporting Initiative. So it deals with both financial materiality and impact materiality. What are the challenges in climate accounting? As climate accountants, we actually have a lot of challenges or shortcomings. One major challenge is data availability. There's hardly data for scope 1, scope 2, or scope 3 emissions. So data availability is a major shortcoming. Number two is the measurement of certainty. Because of the uncertainty of the impact of climate risk on our businesses, we actually have the tragedy of the horizons, whether the impact is 5 years, 10 years. So the uncertainty of the measurement is quite a key factor. Then the lack of standardization. There is no standardized way to report climate risk and opportunities. Even though there are a lot of frameworks, the ideas of reporting climate risk is sort of open-ended. So the lack of standardization is actually a challenge in reporting climate risk and opportunities. Also, estimation and judgment. There are a lot of value judgments involved in reporting climate risk and opportunities, which is a major challenge for climate accounting. What are the opportunities? Just as I've emphasized earlier, climate risk does not only involve risk, it comes with a lot of opportunities. And one of the major opportunities it can come with in the future is things like goodwill. So goodwill is a major intangible asset for the accountant. So a lot of businesses that are sort of moving to a net zero economy might actually have a lot of goodwill when they move to a net zero economy. So this presents a lot of opportunities. One of them too is actually better decision making. We are able to make better decisions because we are looking at the impact the business has on the environment and the impact the environment has on the business, which gives us a more informed decision. It also creates competitive advantage. So companies that are ready to move to a net zero economy will possess a lot of competitive advantage over companies which are actually stuck in the past. Also, access to green finance. A lot of companies are actually, a lot of international organizations are willing to actually fund green projects. So it creates a lot of opportunities. And it also improves reputation. Reputation is a key one because there's reputational risk if companies are not willing to move towards a green economy. Climate accounting is no longer optional. It is essential for understanding the true performance of a business. Truly, we need to actually inculcate the ideas of climate accounting to our business in order to see a robust or a holistic view of our business. And it links environment with finance. So it links our environment with finance because we can't look at finance just from a financial perspective. We should look at finance from the impact it has on the environment and also the impact the environment has on the business, the financial implications. And it also supports sustainable decision making. So we need to look forward into the future and how our businesses impact those in the future and the future generation. So climate accounting is quite a key factor in reporting this consequence of our actions today that might have an effect on tomorrow's leaders or businesses.